Hello, everyone. Welcome to the stock specific class here for Thursday, August 25th. If you have any questions during the week or any questions I don't get to in the live class here, make sure you send those to jerry@traderspro.com. And make sure you're sending them. I haven't had any questions over the last few days, so I've got time to answer them if you got them. So, I should say that because I'm going into a holiday period here the next couple of weeks. So, but if you do have questions, send them, and I'll get to them as quickly as I can. But also be aware, and I talked about this on Tuesday, that I will be out of town. Actually, I'm going to be out of town for the next 2 weeks, and we're going to be doing basically a market update, stock specific. We're going to kind of combine it, although we kind of always do that anyway. It's kind of a combined class. We try to go over trades, potential trades every even in the market update classes. But I'm only going to be doing one of them each week over the next 2 weeks. And so, and in the case of next week, it's going to be on a different day. It's going to be on Monday, August the 29th at 10 a.m. Eastern Time, 9 a.m. Central, 8 a.m. Mountain, 7 a.m. Pacific. So whatever time zone you're in, as I mentioned on Tuesday, if you're in an international time zone, I didn't include that in the slide because I don't know all the different, but I'm sure if you've been dealing with U.S. companies, you're pretty aware of whatever the time change is, and you can figure that out. Basically, it's 4 hours earlier, the start time. I think it's 4 hours earlier. And so there will be no stock specific class next week. That Monday class will be the only class for the week, and hopefully it could work out pretty well because the market's just been on pause. We haven't had any movement in the market this week, and it's been all due to everyone's focused on tomorrow's speech by Chairman Powell, which should move the market better because we're completely dead right now for the last 3 days. And so there should be a lot to talk about on Monday, and it'll be a good time to have it to kind of set us up for the rest of the week and be able to give you kind of at least give you my point of view of what I'm seeing kind of set up after that event. I'll actually talk a lot about today what I think is likely to happen, but we'll get to that. But anyway, make sure you note that. I just don't want anyone to show up next Tuesday and next Thursday, wonder what's going on. There is a recorded, this class is recorded. It's on, if you go to the YouTube channel on and type in Traders Pro, search for Traders Pro, and join the group, you can get access to it. So if you miss any of the information, you can go back and review that. All right, let's get started. Obviously, like I mentioned, the market has been pretty much completely flat. And I don't like that. Movement is the phrase I often use is movement is money. I'm not saying there aren't ways to make money when markets are flat or sideways. They usually involve option spreads, which can be a little bit complex. But it's obvious the market is waiting, and it's kind of ridiculous because I just don't see anything that the Fed. The only thing I think is going to be significant is if the Fed came out and said we're going to start loosening, we're going to start reducing interest rates right now, because that would freak everyone out. Some people would say, well, that's really bullish, let's go buy. And other people would say, wait a second, that means inflation is really going to get bad. And we'd get a massive reaction to that. What the Fed is going to say is, we're going to be hiking rates over the next few periods here. And it could be, we don't know how long it's going to be. It could be, we'd like to be able to do it gradually. But if we have to do it aggressively, we're willing to do it aggressively. I'm telling you right now, that is Powell's speech right there. You had it today instead of tomorrow. And the problem is that everybody knows that. I'm not smarter than anybody else. Everybody knows that that's what he's going to say. And so I don't see that changing anything really. I can see an initial emotional reaction to it because everyone's waited for it. Um, you know, there's going to be people that look at whatever when he goes out and says it. There's going to be the same people that think that that's bullish. It's going to buy off of that. There's going to be people that think it's bearish. They're going to sell off of it. The big question is going to be who's going to be stronger, and that's what we're going to be looking for. But I think this last week, Friday, last Friday and Monday gave us a little bit of a hint. I think that the market is probably going to react, ultimately react more bearish to whatever the news is. Now, I could be wrong, and I'm not trying to predict because again, you know, it could go either way. The market could really go either way. So, but I think when you get that impulsive move that we got over the weekend, Friday, Monday last week, and then it pauses. That's usually a little bit of a clue, and we'll see. I mean, a lot of this stuff is confirmed in hindsight after it happens. We look back and say, "Yep, that's what it was," or we look back and say, "Nope, that's not what it was." But I just don't see anything that's going to change what we already know. And usually the markets are going to react strongly on what we already know. So anyway, before we get to that, real quickly, the directional, again, nothing. The chart updates are going to be fairly quick, just because really nothing has changed since Tuesday's class. Literally nothing has really changed. So there's no reason to go into it in depth and just repeat everything that I talked about on Tuesday. You can go back and review the Tuesday's class if you'd like to get the details here. But as far as the directional alerts, again, we're in the middle. We're off the extremes. Breadth is off the extreme. Sentiment is still in the extreme, but it's off of the far right side of it. We do recognize that sentiment is still probably too high for the market. The market is just not worried yet, and it needs to be in order to form a more firm bottom. I've talked about that for a year now, about how important that is to get that sentiment down a little bit. It's important for the longer term rally. And I know that sounds weird, but you got to have the pain in order to get the longer sustained rally. If the market takes off from a complacent area, it's going to be short-lived, and then you're going to get that bigger pullback later. It means you haven't had it yet. We want to get it over with. So if you want to get the pain over with and get a nice long start of a nice long bull market, you want this panic sell-off to take place. You just don't want to be loaded up in it when it happens, because then you lose half your money or more, and then you're not able to benefit on the rally back up. But we've been doing that in the portfolio. We've been very conservative, keeping risk, balancing out the risk a little bit, having trades that can profit if the market goes down as well as up, and that's why we haven't had huge gains in the portfolio over the last little bit, and that's fine. We're not worried about that. We know the big gains are going to come when we finally bottom out and we can start getting more aggressive. Buy sell ratios, again, same. They're almost the exact same spot they were Tuesday. Sentiment indicators come down a little bit from where it was Tuesday, but not much. One thing, I don't know if I covered this on Tuesday or not, but under the indexes tab right here, one of the things I focused on a few weeks ago when we were overbought, remember how we had those double-digit buy-sell ratios right here? And that's an overbought sign, 12-to-1, 15-to-1. Now we're back down to these lower levels. You can see that, the Russell 2000, you've got a majority that are in the hold section right here. You got about an equal amount that are buys and sells, and that's good from the standpoint if we do start to rally and the market does start to rally, we've got some room to run. Okay, we're not in any of the extremes. We're not extremely oversold, not extremely overbought. But that alone doesn't tell us, well, if you want to see what this is telling us is what direction we're more likely to go in, the recent move has gone from a lot of buys going back to holds. So that's a little bit more bearish. That behavior is a little bit more bearish. Now, this isn't something you're going to be looking at every day necessarily, but it's not a bad idea to go into this index tab and watch the movement. Maybe you just watch the movement of the Russell 2000 or the S&P 500 actually might be better because it's broad, but maybe not too broad. And just see the behavior. Are more stocks going from buy to hold or from hold to sell, or are they going in this direction? You know, obviously you'd be able to see that on the chart itself. I mean, obviously if the market's going higher, you're going to see these ratios moving the same direction. But it's kind of a reminder, though, of what's actually going on. So if you're trying to fight the trend and you're trying to you think that everything is going to drop, and yet you're seeing a flow of many stocks going from hold to buy, you're swimming upstream. You're going against that momentum, okay? And we all have a tendency to do it. What you fight a lot of times in trading is that and there's a lot of people who do this. Some people do it to more extremes than others, but there's a tendency to want to be right. There are people in the market that they really don't care so much about making money, although making the money is going to prove how smart they are. They're more concerned with being smart and smarter than everyone else and appearing smarter than everyone else. And boy, do I deal with these people all the time because they want to prove they're smarter than me. They're obsessed with that. And the problem with that is that you don't look, you're not focused on just going with the flow or going with the crowd. You're trying to predict, and it's just impossible. You can't do it. You can't perfectly predict where things are going to go. And if your obsession is with being right, then what happens is you just ignore. You don't pay attention. You don't see the underlying shifts or movements that are taking place most of the time. Okay, and usually these people also, you hear all about it when they get something right. You don't hear anything from them when they get it wrong, because obviously they don't want you to know they're wrong. They want you to only know when they're right, so that you believe they're always right. And so anyway, I don't want to get off topic here, but this is a way to avoid that. To just, all we're trying to do is, it's not that hard. We're not trying to be on CNBC. We want to just see what the people on CNBC are doing. Where are they doing? Are they buying? Are they selling? Actually, not necessarily the people on CNBC, because most of the big fund managers don't necessarily go on there very often or talk on there. They're too busy working and doing the trades. But we want to see that subtle movement that's taking place, and that's one way you can kind of see it is right in this index tab right here. You can see that movement back and forth. Let's get to the chart. And let me show you what I think, what we need to be aware of. Okay. Now, obviously, we had this sharp move down, mostly from Friday to Monday, and then we were up a little bit today, but we've been mostly just flat sideways. Now, it's important to point out that the basic trend behavior, and I talked about this on Tuesday. I'll quickly review it here. We were in an uptrend, impulsive, corrective, and then we get impulsive up, we get impulsive down. That's usually a sign of a trend reversal. And then what do you look for? You look for the behavior after that. And we've been sideways, we've been corrective. What that should lead to eventually is another move down. Now, maybe this is just wave A, wave B, and then you get wave C, and then we're off and running again. Or this is from Elliott wave 1, wave 2, and you're going wave 3, wave 4, wave 5, and you got a lot further to drop. We don't know what the outcome is going to be. Okay. Now, ultimately, I believe, though, based on this behavior, the higher probability based on this behavior is that ultimately we'll make another move down. Okay, whether that's just a wave C or wave 3, I don't know yet. However, there's this gap right here. It was caused from Friday to Monday. And stocks will have a tendency to fill in gaps. Now, they don't have to do it immediately. So we don't have to fill this gap right now. We could fill it, it could be that this is wave A, wave B, and you get wave C, and then it rallies up and we fill the gap on the way back up. Okay. You can see right here, we gapped down. We didn't fill it immediately, and then we started to move back up. We filled it. And what I mean by filling it is this gap created a space. And usually the market will eventually trade within that space. So back here, it didn't fill, on this rally, it didn't fill this gap, but it did back in here. It eventually filled it in. And so that's what's tough when you start looking at filling gaps, is that, it doesn't have to do it immediately. But we need to know that markets often will do that. So what I'm going to be looking for tomorrow is there could be just an initial reaction. So it's not surprising we moved up a little bit the last couple of days, and I wouldn't be surprised if we get an initial reaction where it rallies up and fills in that gap. Maybe it gaps up, opens up right here, and then trades lower. I would love that. If we got that, that would tell us there's a very strong probability that we're going to drop. I would start looking at as many inverse ETFs to maybe jump into at that point, maybe. No, I'll probably just hold actually, I got out of the SOXS today, this morning, with NVIDIA had their gap up, and AMD and stuff. We'll talk about that here in a second, but I'd probably jump back into that one. But anyway, I think that we could fill that. Now, we don't have to, like I said. So if there is just an initial bearish reaction to what Powell says, that we could just drop from there, and then we could fill it later on. So, but ultimately, the way it's acting right here is it's acting like it wants to go down. Now, we talk a lot of times about the higher probability moves. That's what I focus on in these updates, is what is the higher probability move. But what makes a market is that in order to have a marketplace, you have to have a lower probability outcome every now and then, because if everyone knows what the market's going to do, and the market always does the higher probability move, then you're always going to be right, or you're going to be right, 90% of the time. But when the market throws in all these there's tons of these little higher probability clues, lower probability clues, and if it throws out enough of these little lower probability clues, it keeps you guessing, you're not going to ever have that full confidence that you know what's going to happen next. Okay. Case in point, what happened last Thursday, we had that bearish reversal candle, very high probability bearish candlestick formation, but we didn't pull back immediately off of it. We made the lower probability move. So what happened? Well, then I'm sitting there going, well, what is going on here? I got to rethink this. I got to figure out is that just an early clue of something to come, or is this market so strong it doesn't matter what bearish reversals it throws out, it's going to keep going higher? It caused me to wonder what's going on. Now, when we got the move down on Friday, I said, okay, that's a bearish move. This is probably reflecting that potential drop, and then we got the drop on Monday. But the point is that the market is always going to keep you guessing. It's never going to allow you to get fully confident in what you're seeing. Now, the good news is it doesn't matter. Okay, remember, we don't care about being right. We just want to make money. So, if I had some bearish option trades during this period that I got stopped out of, I lost some money on them. No big deal, because I made more than that on the drop back down when I got that Friday signal. So I don't have to be perfect. I don't have to get it right all the time, but I have to be able to be nimble, to be able to trade, to be able to recognize when these little clues are showing up, and whether I make a trade or not. If I'm just always long and I'm always looking to be long, then when I see these signals, it means I gotta get out, or I gotta hedge a little bit. I've got to buy those inverse ETFs or something like that. Okay. And we did. I mean, I got into, on that Friday move is when I got into the SARK, SOXS. We made some money on that drop, and so we can kind of do the same thing using those inverse ETFs. Okay, so let's look for that. Do we get a move? If we get a move up, let's pay attention to where that gap is. I wouldn't expect it to go all the way back up. In fact, if it does and it gets above here, we talked about this on Tuesday, that would be very bullish. Remember that 200-day moving average? It hit almost perfectly right there. And if it gets back above that, you had Fibonacci levels. I went over all that on Tuesday, showed you that. That would be very bullish. We'd have to turn more bullish. It wouldn't make a lot of sense if it did that, though, because that would mean this was the correction, and you don't get a lot of impulsive looking corrections. And that's kind of what we got here. So they tend to be more choppy, but and you actually I just kind of noticed this too. We got a little bit of because of this pause, this is forming that sideways pause kind of in the same area. You have a little bit of a bearish head and shoulders pattern. So this is where we're going to draw this line right here. And if we break below that, that is very bearish. And not only is it very bearish, but we have a target we can use. We do this all the time with the inverse head and shoulders pattern. You can take the distance from the top of the head, in this case, to the bottom of the head. Usually in the inverse head and shoulders pattern, you're going from the hedge on the bottom. You take that distance and project it downward. So I would imagine if we get a sell-off here, we'd come down to around this level, around it here. And that would make sense too, because if this is an ABC, wave A, wave B, wave C is typically about the same length as wave A. And that would be, and then you look at all the support resistance in this area too. That would be your target. That's where you expect to drop to, at least initially. It could be worse than that, but that would be where I would focus on as far as a target area where we might go if that takes place. So let's watch for that. Let's see if we fill in that gap. Question, do you look at volume to give you a clue in the direction of price? Absolutely, but the problem is we're in August. A lot of people take vacations in August. If you haven't noticed on CNBC, the normal people are not showing up on the different programs. That's because everyone takes their vacation in August. You get done with the July earnings period, kind of starts wrapping up as you get toward the end of August, and it's the perfect, before kids get into school, it's the perfect time for these people to go on vacations, and that's really going. You see this at the end of the year as well. Christmas, a lot of people take the last 2 weeks of the year off for Christmas, so you see these low volume days, and so you have to just recognize that. It doesn't mean that. Well, you have you can just not trade low volume periods. Or you just have to realize you have to look at it in a different relative sense. I might have to look at it and say, okay, well, how does the volume compare to the rest of August? The entire month. Let me still throw volume bars up here. So, I could say, okay, this move was a higher volume move compared to August. The rest of August, that was the Monday move, but obviously it's not these volumes because there's not enough people here. So this is actually a pretty good volume move for August. Okay, today it's pretty obvious that we're waiting for this Fed decision. So you're not going to see high volume. In fact, the last couple of days have been some of the lowest volume days of the year. And again, it's a combination of people on vacation and everyone waiting. Nobody wanted to make a big decision here ahead of this meeting. So yeah, you don't want to be doing a ton during this period of time, but yeah, you do want to see volume confirmation as much as possible. And I don't have to see high volume. I like to just look for average to above average volume off of a pattern I'm looking at. And that, but if we get a big move up, past this gap and we're getting close to these highs tomorrow or Monday, and you're seeing big volume spikes, that's a pretty strong bullish signal that you don't want to be short. You don't want to be fighting that. But again, I wouldn't be overly aggressive buying until it can break out above that key resistance area. Because what you could have is a situation where you go strongly up to that area and then you just get a double top. It fails again, and then it starts selling off and rolling over there. Kind of happened right in here. Well, we just moved sideways there and punch out above that and then start to drop. All right. Now, if we look at the other indexes, Dow, again, the gap on the Dow is because it had another down day on Tuesday there. It's a little bit higher up. But if you look at the Qs, it started to kind of fill that gap a little bit already today. It's not that far away. And then if you look at the Russell, technically it's filled the gap. Okay. So, do all the indexes have to fill it? Like I said, it doesn't have to get filled right away. Usually gap fills are more significant in commodity trading. They almost always get filled in commodity trading, but it's not always the case. That's why I'm trying not to put a huge emphasis on it. It's just something that I noticed. And so I'm thinking to myself, okay, if we rally, how far do I think we could rally? Well, I think we could fill in that gap, and then and then see what happens from there. Just like I think tomorrow, one thing you have to be aware of tomorrow, and I point this out a lot of times when we have Fed meetings. Now, tomorrow's not a Fed meeting; it's a symposium at Jackson Hole, and it's just where it's just an excuse to have a holiday and a get together for all the Fed presidents, and they get interviewed, and everyone starts picking apart everything these different Fed governors say, and then Chairman Powell will give a speech. There's a lot of speeches, and so there's that focus on this. So you could have the same type of reaction though, where you have an initial. And by the way, he speaks tomorrow morning when the market is open. So it's probably going to create a lot of volatility during the trading day. And so just be careful, because there could be an initial reaction. And so, I talk about a gap up to fill the gap, and then a sell up. But what could happen is we open flat, he starts speaking, the market takes off, initially reacting bullish. You got to be careful, because you start chasing it. Could be a sucker move. You see this all the time with those Fed meetings, and then it could then reverse, not necessarily reverse that big in one day, but it could come all the way back down, have a bearish looking candle, and then it could really drop on Monday. Okay, so the good news, I think, is that the speech will be during market hours. So if you have to make a decision on something, you could, it's not like you wake up overnight and it's made the move. It gapped up or gapped down. It's hard to, be able to react to that. But just be aware, you could get a false move, just like you do with those Fed meetings. All right, let's get going here on. I'm not going to spend too much time on these others. Now, TLT, it threw a little bit of a. Remember on Tuesday we were looking at this trend line right here. We're looking at the possibility of the inverse head and shoulders pattern, but we were dipping below that trend line. And I said it's becoming less likely. It's looking more like it's going to make a move lower here. But now we have this big reversal. Now, again, this is going to be tied into tomorrow as well. And we're not done with today. If this fades into the close, it could still look pretty weak. Did that on this day right here where it looked like it was moving up and then it faded. That was on Tuesday. But if it goes higher from here, it still could be that could be an inverse head and shoulders pattern, and that's a higher low right there still. So the key though would be then, do we break out above here? That would be really bullish on bonds if they could do that. So we'll see what happens with the reaction of bonds. Gold did move up a little bit off of this. Again, if it can get above here, it'd be more bullish. It would mean that that's a higher low. It could then going to a higher high. But gold's been really unpredictable lately, and I wouldn't have a lot of confidence in any trade on gold. Oil's down a little bit today. Now it is a bearish. That's a bearish. If it holds this going into the close, that's a bearish engulfing pattern. It's engulfed the entire move of the day before, and it's in the opposite direction. So this was up. It's engulfed it. Now these are very short-term indicators, so it could mean that it should have a down move the next day, whether it's just opening lower and then that's it, or trading down from there. Maybe it's a signal it's going to work its way back down to the lower part of this range. You know, I told you that in the near term it was bullish when we broke above that triangle formation, but I said we got more resistance up here, and it looks like we're bumping into that resistance. So it could mean that we're just in the sideways range for a little bit. But if we do break out above here somehow, that would be more bullish for oil in the near term, and you know, you could look to maybe trade that. We do have oil exposure in the portfolio, but just one trade right now, and it's actually been doing pretty well. So we'll just continue to hold that. The dollar still bumped up against this area. It's been up. Now, I'd expect it to continue to go up because this is impulsive. This is corrective. You would expect that next move should be impulsive up. But again, this is another thing that's waiting on this. See how everything is just, it's kind of like a big event, like a Super Bowl or something. Everyone's all hyped up, focusing on something, and then that's the thing is when it's done, it's like, you know, it's like I feel like after every Super Bowl, it's like it's done, and it's like, oh crap, football season's over now. I gotta wait how long until it starts up again? You know, all this build up, and then you know, and that's probably what we'll see happen is it's you know, all this stuff on pause, but it does kind of feel like it's building towards this pause. In this case, this feels like this pause is building towards something big, which is fine. Again, movement means money. We can make money whether the market's going up or down, but we just need it to move. It just hasn't been moving very well. The VIX, again, the VIX has come back down quite a bit since it had that spike, and this surprised me a little bit because typically you'll get when you get that kind of a jump in the VIX that we saw on Monday. You know, you could have a day where it pauses, or even a couple days where it pauses, but usually it's going to spike again. It does it so many times that this is another reason why I think that ultimately the next move of the market out of this whole thing is going to be lower. But the market will sometimes do the lower probability move. That's why I'm not overly confident that I'm going to get that drop. But there's enough of these clues to really believe that it's more likely to happen. I would definitely put it as the higher probability move is for the market to move a little bit lower. But watch for that. If you get a sell off and you get another big spike in the VIX, that means that there should be a few more sell off days along with it. SMH, this has moved up pretty sharply off of the NVIDIA news. By the way, that filled in that gap. There's a couple ways to look at this. I talked about the fact that it did not confirm the market move, or the market went above the June highs. It didn't go above the June highs. It's supposed to be the leading indicator I talked on Tuesday about the fact it did go to a lower low right here where the market hadn't gone below that low. So I was figuring maybe now it's leading, but it's leading the way down. Same thing could happen here. This could be it's first filling in the gap ahead of the market, and then maybe it rolls over and leads the way down again. But there is another way I got to look at this. Could this be a bullish ABC pattern right here? That's definitely a possibility. And could it be that the chip stocks are the first to break out back up above that June high before the market does? If it does, it's leading again. Now it's leading up. I'm going to pay attention to that, and that'll be a very bullish signal if that were to take place. So that's something we'll watch for as well. We'll see how that goes. It's worth noting that although Nvidia is up and some of these chip stocks are up today, their earnings reports and their outlooks were really bearish through their earnings reports. Now, again, I'm not a big fundamental trader. I only care what the chart is telling me, but it is enough to make me wonder, with the market condition looking bearish, do I trust this rally today on chips? It doesn't make a lot of sense. So not that I'm going to fade it or anything, but it would have to start to break out, like I said, ahead of the rest of the market for me to turn more bullish on chips. If it could do that, I'd be really bullish on chips at that point. But it's going to have to do that. Transports, they filled in the gap. This is kind of what could happen tomorrow. You see how it traded up, filled in that gap, and it's pulled back. If it closes this way, that's a bearish candle. Now, you didn't get a huge run up ahead of it, so it's not the strongest bearish candle. You had a pretty good run up to this one right here, and even then it moved a little bit sideways off that before dropping. But that's worth paying attention to. Could it be leading? Is it leading the way, filling the gap first? We're comparing this to the Dow. Remember, the Dow was really far away from filling in that gap. Is this kind of a leading indicator on that? We'll see. That's why we look at it, as we kind of compare it with the Dow Industrials. And then Bitcoin has been sideways. We're really bearish at the move over the weekend last week. That was a pretty big move down. We've been sideways here, but I think ultimately Bitcoin is going lower. That was a pretty big drop there. And definitely if the market goes down, you're going to see Bitcoin goes down, because again, that's risk on, risk off type trade. Now, if it really starts moving higher strongly and it starts looking impulsively upside, that's a risk on sign. And you'd want to be focused a little bit more on like the Qs. Maybe we do a trade on the Qs, the Russell 2000. Those are risk on type indexes to kind of focus on. All right, let's get into some individual stocks here. Well, first of all, let's pull up the portfolio. Like I said, I got out of the SOXS this morning. Still made a little bit of money on it because I got in on this gap up before that gap up. But now it's come all the way down. It's filled in that gap there. We already kind of, this is going to do the opposite of the SMH basically. But I want to see what happens. I can jump back into this one again. If the market starts selling off, we'll jump back into this, because this could really move up very well if the market sells off. But I did get out of that because I didn't want I didn't want it draining the account, because it can. The reason why we're trading these is they can make bigger moves when the market makes these moves, but they can make them against you as well, bigger moves against you than some of the more traditional inverse ETFs. So all we're using them for is just to hedge. And so we're basing them off of, again, the price action we're seeing right now, the candles we're seeing right now, and some of those things. CNQ still looks fine. We're up today, breaking out of this range. This is our oil exposure, but it's been looking pretty good, and so there's no reason to do anything with that one. SARK, this is our inverse ETF for the ARKK, the ARK Innovation Fund. It'll do the opposite of the ARK Innovation Fund. So this will go up and that one goes down. It's come down a little bit right here. But this, again, looks a little bit more corrective. It's not as a big of an impulsive move down like the SOXS. So I'm still holding on to this as the hedge in case we drop. I want to make sure we have something to make money on if it rallies back up. But I'll watch it. If it really looks like the market's going strong, I'm going to get out of these inverse ETFs. We added another one. Oh wait, actually we have another oil one. I forgot we got into Suncor. It's got a little bit of a bearish reversal candle today. I'm going to get out of this one. And again, this is not normal. I have to emphasize, this is a trend trading software, and it's designed to not to do a lot of short-term trades. But like I said, when you're in these bear market conditions, you have to be a little bit more nimble. You're either going to buy some stuff and then just not even watch it for the next 2 years or something. You say, well, maybe we're not at the bottom, but we're closer to the bottom than we were a few months ago. So I'm just going to get in and I'm just going to forget about it. In which case, you're not showing up to this class because what do you care? You don't want to watch what the market's doing. I'm assuming that people in this class are looking to learn some things and learn how to, if they want to be active and do something on a daily basis, what can they do? What can they do during a bear market condition when they're usually looking to be in trades for several days or several weeks? When we bottom out, that's what, the class will get boring a little bit when we bottom out because the portfolio will be full and we'll just be sitting here in the same trades. They're keep going up. We're moving our stops up, and we're just I'm gonna have the whole portfolio full. Now it doesn't mean we won't have new trades I'll talk about, but so just keep in mind that some of the stuff right now is unique. But what I'm seeing right here is I'm seeing a bearish. Now again, this could change going into the close, so I'm going to go ahead and get out of it now just so people can see how to do that. But it probably wouldn't be a bad idea to wait to the close because these can change in that last hour sometimes. But you've got a bearish, you got a rally, nice little rally here, and a bearish reversal candle. And this would be a black. This is what I call a black candle because on my other charting service it shows up as a black candle. You're saying, well, wait a second, Jerry, we're up today. Why are you bearish? Why is that a bearish signal there? Well, because what happened today on the stock is we gapped up here. Here's where we opened. We traded up to here, and then here's where we're at right now. We're trading lower than where we opened, but still higher than where we closed the day before. It's a real subtle momentum shift. And like I said, it really is stronger if you wait till the close. But here's one that took place right here, and right after you got this pullback. So my thought process is, yeah, my stop is down here somewhere, but I can always jump back in this thing again. If this thing could drop here, and remember the oil stock, the USO we were looking at was at the resistance of that sideways move and could come down to the bottom of the move. I just see too many reasons to, and I've already got oil exposure that I want to keep. I'm going to keep CNQ, but why hold both of them when this one's showing a bearish signal? So let's go ahead and just get out of this one. Like I said, we can get back in again. But it's hard for me to see that context there where I know there's a very high probability it's going to pull back. And if it doesn't, I already have the other trade to do well. It should do well. So I'm going to go ahead and just get out of this. Make sure I got the right current price on it. 34.75 is the current price. So actually we get to boost that up a little bit. So we have a $145 profit. Not much to scream about, but that would turn into a loss if it pulled back the next day. So might as well not have that exposure. That leaves us with the SQQQ. This is an inverse ETF. Again, this will go up if the market goes down. again, I want to wait and see what happens on this and the SARK tomorrow. I am going to add at least one bullish pattern, bullish trade to this in case the market takes off, so we can balance that out a little bit. So let's go into our sectors here. One I found under consumer staples. Some of these are the same ones I've been talking about just because we haven't moved really. We haven't done anything. So, but I was looking, this one's under the buy section of consumer staples. Just barely went to a buy signal, but the CELH, Celsius Holdings, 96 strength rank. So this one here broke out. Let's switch this over to signals here. This one broke out. Now what you could just buy that breakout and then put a stop down below here. Give it a little bit of room because it'll probably come back and retest the breakout, especially if the market sells off a little bit. So that's a good sign right there. I just would, if the market pulls back, this is when you want to keep an eye on to look for maybe an entry. And maybe what happens is it goes back down to a hold signal, and then you get in when it goes back to buy or something like that. But this is a nice trend. This has been outperforming the market. Market's been dropping. This one's been going up. So that's now, if you're waiting for it to pull back and retest, and it has a real impulsive move down, and it comes right back down to these lows, and you want to stay away from it because that would be impulsive up, impulsive down. But it would have to have a straight shot back down to this area here before I would think that, what you're kind of hoping for is if the market moves down, this would move down, but you'd have these days like this where it's trying to fight it, where it's these small candles where you have a day where it gaps down and tries to rally, or it looks a little bit more sideways around here. Those would be good bullish signs if the market pulls back. All right, so this wouldn't be one you'd want to jump into right now. Business services, this RCMT is one that I've talked about a few times, 99 strength rank. And again, it's had this sideways move, it dipped down, impulsive down, impulsive up, and now it's corrective. You probably want to clear, it's been moving sideways. I don't want to get into something that could move sideways for another month. Moved sideways for a month right here before doing this move, and it's been a few weeks, at least a week there where it's moving sideways. Let it start to act more impulsive, break out above here. But if it does, this is a nice little, could be a nice little trade. Now, if this is kind of that inverse head and shoulders pattern, again, you can take the distance from the bottom of the head to the neckline, project that upward. That lines up with resistance in here. So this thing could get up to about 2366 area, possibly, if it can start going. This one probably needs a little bit of confirmation. And then in the new buys, in the business services under the buy section here, this is one I've talked about before. NOV, 94 strength rank. But it's starting to break out right here. I like this impulsive down, impulsive up, corrective. And now it's starting to break out. Although, again, that's a bearish candle there. So you wouldn't want to jump into this thing today. It might still be in the sideways range. But if it starts breaking out clearly above there on a nice bullish candle, that could be one you could jump into because it should get back up to that previous high as a minimum target. It should break out and go above it if the market's rallying and taking off from here. That's a big question mark. Again, is the market, have we bottomed? Have we not bottomed? And the bottom line to keep in mind, if you're really worried about, the only difference would be that we're not getting aggressive, So if you think we're going to miss the rally, we're not going to miss the rally. I'm trying to get into high high strength rank stocks that are trending up trades. I'm just not getting into a ton of them. And as the market confirms more and more that it's could be done, it could be bottoming out, I'll add more and more and more. I'll add more exposure. So, this idea that you have to pick the bottom to make money is ridiculous, especially since we can make money when it drops. So, we just want movement. Just give me movement and we'll do fine, All right. So that's one I like. Pay attention. You put it in a watch list there. The sector, though, I really like today is aerospace. And I've been in aerospace before. But I'm looking to add another one. Lockheed Martin's been right up there on the top list. It's just below 90 strength rank, 89 strength rank. But I like the pattern here. It kind of broke this downtrend, lower highs, lower lows, and then it went to a higher high. And then the smaller trend, impulsive, corrective, impulsive, corrective, impulsive. This could be wave A, wave B, and you're going to get wave C, and then it goes again. So there's a little bit of danger in that maybe it has one more move down, especially if the market sells off. It could sell off with it, but I like the overall formation on that. Now, one I like a little bit better is already a buy, and it's one that I've been in before, which is Northrop Grumman, NOC 92 strength rank, a little bit stronger strength rank, and it's breaking out to new highs, new recent highs right here. It's already been kind of acting like an uptrend, up impulsive, corrective, impulsive. Now this could still be wave A, wave B, wave C, but I don't expect it to go below this low. And if it does, I got a tradable range here. We're going to put our stop down below here. And if, so if it continues to go higher, then we can then move it up below here. If it doesn't, like I said, it could just be wave C and then take off. I'm going to give it some room to be able to do that. Now, the other thing is I could wait and do nothing. But what I'm afraid of is if this market does take off of this event tomorrow, I don't have enough bullish exposure. I got one oil stock and two inverse ETFs. So I've got to balance this out a little bit. So I'm not worried if it has a wave C down, because I should make that up with the SARK and the SQQQ. And I might even then add the SOXS again and take advantage of that drop. But I want to have a little bit more exposure. I like the way this has been trending with the market even selling off recently. This has still been trending up. I like the fundamental story of these stocks. I don't know if you missed the headline, but Ukraine's still buying weapons. There's news stories of how countries providing weapons, and we're the leading country in making the weapons. And so these companies are going to make money for the next several years. So we want to have some exposure to this as much as possible. So I'm going to put my stop down below here. So it's going to be at, let's just say 465. That would be right below this area here. Let's add it to the portfolio. 465 stop. This is kind of an expensive stock, so we might only get about 20 shares. Yeah, about 20 shares. Let's make sure everything looks good. That'd be almost 10,000 in the trade. I like to try to stay within that 7,000 to 10,000 per trade allocation. That doesn't mean I'm willing to risk that amount. This is where I look at the risk. If I do get stopped out at 465, I'm looking to lose about $500, which is it's less than 0.5% of my portfolio. So the range, I don't like it to get above 1.5%. And we're well below that. But you also have to look at this as Are you willing to risk that amount? Because that's what I'll lose if I get stopped out. Some people, that's too much. Okay, if that's the case, you're going to buy fewer shares. Maybe you need to get that down to $200 or something like that. Do it, because that's important. That's an important part of trading, is you've got to be able to accept the risk. You got to get the risk amount down to where you're not emotional about it. Okay. Now, I think everyone in this class would be emotional about a $10,000 loss. I mean, I know people that even if you're a millionaire, you have a $10,000 loss, you're freaking out. Now, but how many of you would freak out with a $100 loss? You'd be mildly upset. You don't want to lose it, but you're not. It's not going to ruin your day, right? You're not going to be like in a catatonic staring at the wall and wondering what you're going to do, how your life is going to be destroyed, or how you're going to make your mortgage payment now, or something like that. You got to get that amount down to a level that you can handle, and that's different for everybody. Now, the range I'm using in here is that 1.5% of my $100,000 account that I started with. If you've got a $20,000 account, then you might want to, whatever that 1.5% is, maybe that's it's I don't have the automatic calculator in my brain, but so would that be 20 anyway? What would that be, like $200, something like that, $250 or something like that, $450 or something like that. So whatever you'd have to get that amount down to where you can handle it. Okay, and that could mean you adjust the amount of shares that you're buying. And that's important, because if you're just trying to mirror what I'm doing, exactly how I'm doing it, you might not be emotionally able to do that. And so on a day where I lose $1,000 and that was less than 1.5% of my portfolio, you're freaking out, because you really can't afford to lose $1,000. You know what I mean? So make that adjustment. Make sure you're focusing on that. That's a critical part of trading, that you accept the risk that you're taking. And it's, like I said, it's going to be different for everyone. Question: we're still waiting for the big flush out before the market retrends upward. It should do it. Every market bottom has had that flush out sell off that I've seen in my lifetime. But like I said, the market can sometimes do the lower probability move. We're going to expect the higher probability move until it doesn't make sense to do it anymore. If we keep grinding higher, we're going to trade that move higher. I'm going to add more positions. I'm not going to be waiting around to be right that I have to get a panic sell-off. Okay. But I also don't want to grab onto the lower probability outcome and just assume the lower probability outcome is going to take place. That doesn't make a lot of sense to me. So, but again, it doesn't mean that we're going to sit here in cash and miss the entire rally if the market starts taking off. We'll add into it. We're just going to be real cautious, and we'll look for warning signals that maybe it won't last. Okay. All right, so let's go ahead and pull the trigger on this purchase. And go from there. Let's take a look at our portfolio now. So, and if you've noticed, we over the last week, we were like at 122,000. We went up to about 120, almost 126,000, back down to 120. We're just kind of sloshing back and forth a little bit. We're just trying to grind out some profits while we're waiting for the market to move. The other thing, again, is, like I said, you just get out. The phrase I tell you, and you're seeing the proof of it right now. the reason why I hate sideways markets is if you're going to trade them, you end up working twice as hard for half as much money. And in this case, a lot less than half as much money. We're not making much money here. We're doing a lot of work for nothing. But the other alternative is you just get out, you go on vacation, and you wait until the market starts moving again, And I'd love to do that. I wouldn't have a class to teach, but I think a lot of you at least would like to learn some ways that you can trade sideways markets. So that's why I'm here. Just don't have high expectations that you're going to make a killing. During these periods of time. All right. So those look good. We got a little balance there. Here's our two inverse ETFs. I did get a question on, are there other inverse ETFs you could consider? Trying to get this thing to work here. Why is that letting me type in there? Oh, here we go. There is the SPXS. This is the triple leveraged inverse of the S&P 500. So it's kind of the same as the SQQQ. This is one we could jump into if the market starts dropping. This should go up if the market goes down. This can allow us to be long the market so we don't have to short stocks. That's why we're using these. It's just that we don't want to use these leveraged ETFs very much unless you're getting movement right away. With the market not moving anywhere the last couple of days, and we're in the TQQQ, it needs to start moving here. We don't want to just be holding on to it. So there's a little bit more risk with these leveraged inverse ETFs. If you want to go in the same direction, we're the TQQQ. The SQQQ is just short. The TQQQ is if you want to have leverage going up with the Qs. That's this one right here, and that's the NASDAQ 100. So if NASDAQ 100 goes up, this will go up, but it'll go up 3 times what the NASDAQ the QQQ goes up. Got to be careful with these. These are not. You're not going to get that. You're not going to continue to get triple movements. It doesn't mean you're going to triple your account for the movement that the Qs make, because it resets every day. You could have a situation where the Qs are going up and this is actually losing value. Then there's the SPXL, which is the bullish leveraged ETF for the S&P 500. So we're not. If we're going to be bullish, we're going to use the SPY. If we're going to try to trade the market up when it's going up. For the most part, we may throw a few of these in there every now and then, but not really going to be our focus. I usually just like to use the inverses hedges. But that's, the SPXS is one that we could be jumping into. We're already in the SQQQ, and so we'll see how that works out for us. Real quickly, let's take a look at the market here before I wrap things up. And why is this not updating? Okay, I'll just go to the watch list here. Yeah, I've had some weird things happening. Okay, so we're off the highs of the day, so we're fading a little bit into the close. We'll see. Again, that could change between now and we got an hour left. We've seen a lot of that lately, where we've seen these we've seen a lot where it's faded the first half hour of the last hour, and then it's rallied a little bit into the close, which we saw a little bit of that yesterday. It came way down here, and then it rallied a little bit into the close. Bottom line, it's waiting to tomorrow, so we'll see what happens tomorrow. All right, thanks everyone. Have a great weekend. Remember, the next class is Monday, and that's the only class next week. And I'll try to make sure there's enough information in it to get you through the week. And then the following week after that, there's only one class as well, but it'll be on Tuesday, and it'll be at the normal time on Tuesday that week. So that the only one that'll be changed will be next week. All right, thanks everyone. Have a great week, and we'll see you next week for the next market update class. Bye now.